Welcome to another video of Joe Spinach. Today we have an interesting topic to discuss with my friend Lucas that we have here before. Lucas is an entrepreneur, a businessman, and a very intelligent mind, Lucas Pinkers. And today we're going to discuss about ESGs, so environmental, social, and governance policy that was introduced kind of in the market by the late of 2019 and so forth. And we're going to have a discussion on the validity and the pros and the cons of ESG. Now, the argument in regards to the pros of the ESG, well, I don't agree with them, but the argument they give is that they give ratings to companies to how inclusive they are with their staff, with their environment, with their work ethic, how pro environment they are, and the policies that they do, and they give loans, like they get better interest on their loans, so they're getting approved for loans based on their ESG score. So if you're an oil company, you automatically get less. The irony of the ESG score, in my opinion, and I'm going to move to Lucas, is, for example, Tesla in some ESG scores scored very high. Obviously, it's an EV company, and in others, it scored like really low, while Shell, for example, an oil company, scored high because they did diversity training, which it's absurd. Now, Lucas, what are the cons of the ESG training?
Well, I would say first, I would say that there's two problems, I would say, with it, right? So first of all, the idea that it tries to do is it tries to, by giving scores to companies, it tries to sort of allow like environmentally conscious investors and stuff. You have all these like ESG ETFs and stuff to give more capital to. The idea is to basically give more capital to like good companies and like starve capital to bad companies. That bad defined as and not good for like, you know, environmental or social, etc., right, by these standards. So the idea is that, let's say, you know, by giving sort of more money to like, you know, renewable energy companies and less money to all companies, will eventually have more renewables and less oil, etc. Well, there's two main problems there. The one problem is basically who decides what is ESG, as you just alluded to, like the fact that Tesla in some cases has less ESG score than like Shell is ridiculous. And the problem is basically that ESG is not really, from a bunch of like people that genuinely care about it. No, it's like you have these big asset managers like BlackRock and Vanguard that have all these mutual funds and ETFs and stuff, right? And then you have this whole new generation of like environmentally conscious people and like people that want to invest in, they want to do good for all, or they want to put money into something green. And what is the best way to get money to go to your fund? Well, you see, it's a green fund, right? A green investment, green bank, green this, right? Because that's how they attract more money into their funds, what they charge fees on. But they themselves don't also say what's ESG. No, there's basically one or two companies. The biggest one is MSCI, which is in charge of like generating ESG scores. And they have a fairly standard outline. It's a massive document procedure how to do it. But you can so easily rig this, right? This is why Shell has like higher ESG scores than Tesla, because one of the main components of it is like, it doesn't actually matter how good you already are. It matters that you're improving. Like if you're a company that is like just literally burning for the shits and giggles like gas to emit CO2, and then you're like, we're going to reduce it by 10% a year, you get a higher ESG score. And, you know, if you just hire some consultant to give some diversity training, which no one gives a shit about, but just because you can say it, you have a higher score, right? Like it's very easily riggable, and that's why ExxonMobil and can have a higher ESG scores than other companies, right? And that's why nowadays any investor presentation or stuff you'll see like companies being like, oh, we're green and this and that, right? It's all corporate bullshit to get a higher ESG score. And that's the first problem, right? These scores are they're not always accurate. They'll give but let's just say hypothetically we had perfect scores, right? Like you would always get good scores for renewable companies and bad scores for companies like Shell and stuff. Does that really achieve what we want to do? I think that it maybe does more harm than good in many ways. For example, right, like the big like tobacco companies like Philip Morris and British American Tobacco, etc. They have had low ESG scores for forever because smoking is bad, right? And so a lot of like companies and pension funds and they divested from these smoking companies because they don't want to have to do with smoking. But does that really cause people to smoke less? No, because these companies they don't need more capital. They are like super capital light. Like it's very high margin business to make cigarettes, and it's a declining industry. Because you starve them of capital doesn't mean there will be less people smoking cigarettes. And all you're doing is, if you, for example, look at the performance of like tobacco stock versus the general market index, they have vastly overperformed over the last 20 years. So all you're doing is like you're basically taking money away from the pension funds, from pensioners and stuff that could have invested in these companies, and they get less money. Basically all these good investments, and just sort of pension funds make less money, and still
And the irony thing we said about smoking, it's a really cool thing that in the past 10 years, we've probably seen the best innovation when it comes to tools to reduce smoking by creating various devices that are still harmful, but are way less harmful for smokers. And on a personal note, I've been a smoker of normal tobacco for quite a long time, and then I've switched to a lesser degree to these IQOS things, which in theory are better. But in the ESG score, if Philip Morris does reduced in pollution and, for example, does things such as diversity training, which has nothing to do with the environment, but they do diversity training for some reason, they get the loan, and the other smaller companies, which are really hard for them to begin with, compete with a company that has a clientele of addicts. It's really hard for them to compete, and really even more harder for them to lobby. And on that aspect, for example, we've seen that Philips Morris and all of these other companies, they have lobbied for harder regulations on smoking, for example, equipment, mainly because they know that they're going to get their profit anyway because of the inelasticity of their buyers. But their competitors, which are much smaller companies, and it's really hard for them to enter the market to begin with. And for example, IQOS, they have to sell you, first of all, the equipment, and then you have to buy the actual things to smoke. And because of all of the taxes and everything and the minimum prices they enforce, they actually sell on the same price as the actual smoking, despite the fact that they are less harmful. But the ESG by itself, in my opinion, contradicts itself, because at one subject, it argues about environment, on the other about diversity and social investment, but on what basis? If I have a Chinese company that literally has slave labor, it can still get a really good ESG score because it's environmentally friendly. It's absurd. While at the same time, I can have a gas company that is polluting and destroying the environment, and neither of us, just to make it clear, neither me nor Lucas believe that there is no global warming and that we are all going to be fine. We understand that there is a massive issue in that aspect. I think Lucas totally agree with me. But the ESG thing promotes this oil company to continue producing more gas if it does diversity training. Now, one question I have on you, Lucas, is that, in my opinion, well, as an Austrian economist in mindset, the market by itself is self-correcting. It may take some time, but nonetheless is self-correcting. What do I imply by this? If I have a very racist company, and that racist company continues to be racist, and I am in a very wealthy country. Wealthy means that individuals, people that purchase, have money to spare. Then they will by themselves stop buying from that company and go to their competitor because of what they did. So the market punishes. And a good example is Bud Light, when they started to virtue signaling to increase their ESG score by promoting transgenderism and everything. And the market was like, no, fuck you. And it completely destroyed the whole company. So their attempt to create a better ESG score destroyed their income, destroyed all of their shareholders, which are exactly the same people that the pension funds and so forth are investing in, which makes a whole contradicting cycle. My question then comes to, since we know the market is self-correcting, and we know these big billionaires and millionaires that make the investments know that the market is self-correcting. They lived through the market, especially BlackRock. They are specialists when it comes to the market. Why do they push for this agenda? For me, it just doesn't make any sense.
I think that you're giving too much credit to like the likes of BlackRock and stuff. Like they don't really have the most brilliant managers there. Like what they simply do is have these giant funds with a team. They'll say, we'll invest in green energy, we'll invest in, they just have a bunch of funds, but very low management fees. And people just pile money into them, right? Because they want to invest as an index investor or something, right? And they just, they hear there's a demand for green investing, because the people that invest that money, like, I don't know, like, let's say my mom, she, likes the environment, wants to invest in green. She's not going to do complete research. If BlackRock comes along and look, hey, we have a green fund, it doesn't matter how good they perform, as long as they say it's green, right? And so they just notice that people have this need to do good for the environment. No one wants to invest in racist companies or invest in, companies that pollute the environment. Everyone wants to do good, right? And so they'll sell you this product that you're doing good to the world. You're improving the world, you're investing in ethically responsible companies, right? But really, the entire methodology is A, horseshit. It's very easily riggable, but I think it's also B, even if that index would be correct and it's not riggable, it makes no sense. Like it causes harm. As an example, because like the Western world is only so much of the whole world, right? And in the Western world, we at least have some environmental legislation stuff. As an example, right? We, if we want to go for, green energy and stuff, we need windmills, right? And solar panels. Let's say we need solar panels, right? Solar energy. And so you'll have these companies, let's say in Europe and the US, that they install solar panels and they operate these, these giant solar farms, etc. Right? Those will get enormous amount of investments, right? Because they're super green, they get a lot of extra subsidies and greens and all these green investments, and they have the highest ESG scores. But they can't manufacture the solar panels, which is incredibly like energy intensive. You need to melt silicon, like sand, to produce like the silicon which the solar panels are made of at very high temperatures. It's incredibly energy consuming. And well, shouldn't really do, and that process also emits CO2 by itself, not just the energy, it will automatically emit CO2. And so you can't do that because it's really bad ESG score, right? So like they don't get funding for that. So what you get then is in Europe, you have all these companies that install the solar panels and stuff and operate the farms, but no one makes the actual energy intensive, heavily polluting silicon stuff because we don't want to give money to that because that's bad, but we still need it, right? So where does it come from? It all comes from China. So now our entire solar production value chain originates in China, and all the polluting stuff gets done in China. Well, if we had done this in Europe, right, because it's like it gets done anyway, right? We produce these solar panels anyway. If we did this in Europe, we could at least, let's say, make sure that the energy that's used to produce them is clean, that we potentially, store the CO2 on the ground or something, right? We can do it in an environmentally good way. Now, this gets made in Western China, partially by Uyghur slave labor. Also, there's like enormous like coal, like the most disgusting like coal power plants, entire lakes polluted. Like you can look it up on Google Maps. It's like this entire area is just totally polluted with just pure coal energy to make these solar panels. And we're like, oh, look, we're doing great, ESG. But all ESG did was move. It doesn't remove, because the world still needs oil. The world still needs to make these solar panels, right? And we punish people that made them in the West because they get low ESG scores. So we just push it away to China and Africa and Indonesia. We have no control over them, and no one gives a fuck about the environment.
Yes,
so
but,
we just actually, I would argue that even if the score works, I think it harms the actual progress that we want to make.
The argument I would make is that it's generally harmful, the ESG, especially for innovation when it comes to new companies. But, and of course, it signals virtues, a lot of things which I disagree quite extensively. But the question is that in when you give the ESG score, it's not like it's given by governments. It's given by private institutions like banks and BlackRock and other investment
MSCI
firms.
Mostly.
Yes. So when the next crisis comes, and the next crisis is going to come, it's definitely in June. If it's not the next year, it's in 2 years, in 3 years. We live in the cycle theory. The next crisis is going to come. And a lot of this investment just going to go down. And I refuse to believe that they cannot apprehend that if a company is not financially viable, it receives loans to do further investment, and it will do so for an extensive period of time, and thus accumulating quite a lot of loans, and then believe that somehow that investment is going to pay off. And I think that the market is going to self-correct itself with this whole ESG thing, that they're kind of shoving it into our throats. But as we have seen, for example, with the Bud Light, as we have seen with Gillette prior, when they make that advertisement, that they signal virtue to men and everything, and the market, it starts to react back. And I'm really optimistic that eventually the market, well, the Western market will understand the idiocy of this ESG score.
You're starting to see anti-ESG ETFs launch that basically they'll buy like all the stuff, for example, that the ESG.
Oh yes, and it's like really good investments.
Yeah, you are, and you're seeing that like ESG stocks. I mean, these companies were never good, but the price kept going up because their market is green, and more money piled into these green funds. So even though the fundamental company was not doing great, the share price went going up. So everyone was like, oh, it's really good to do an ESG investment, but it's like a Ponzi scheme. It needs more and more money. But eventually that pile of money that wants to go into green energy from a regular investment dries up, right? There's only so much money that can transition from normal to like ESG investing. And so now you're starting to realize that way too much capital, like trillions of dollars, just got misallocated into like sectors that were not that big or that profitable. And now you slowly need seeing this, more and more people questioning ESG, because like what in the end matters is people want to make money. They're all fine with investing in, green stuff and whatever. But when the investors are actually underperforming significantly, they'll start asking questions. They're like, hey, is this really, but as and so I think we're now going to get to a point where more and more people are aware of like, oh, not just this causes me to lose. It's like they're starting to underperform and lose money, and now they're looking at more starting to question like, how is this entire methodology even working, and that it's riggable, and like that ExxonMobil has better ESG score than. You're starting to see pushback. I think we definitely passed peak ESG craziness.
As long as government does not intervene. The moment government practically intervenes and provides,
but they are
something,
intervening, sort of, right? In the sense that they're already giving a lot of subsidies and like.
Oh yes, they are intervening. But what I'm saying is, which I've heard about it, like you can have the central bank, for example, having different interest rates based on various ESG scores or similar.
I would not be surprised if you see the ECB
if they do that, though, that could be quite disastrous, because then, in contrast to the free market, even BlackRock has to submit to the will of the free market. Mm-hmm. But governments don't, because government bureaucrats are not affected by the market. They don't receive the consequences of the market. BlackRock, Microsoft, Apple, they can play those white knights and these virtuous fighters of green energy and everything. But the moment the company just goes, that's the moment they just abandon everything. They go and make themselves more efficient.
They'll do it either because it's a very low cost to them, right? Like it doesn't really cost Microsoft much their bottom line if they get their energy for a data center from green energy, right? Or if the market rewards it. Like the only reason that Apple recently brought out carbon neutral new watches, they only do that because it's demand for them, right?
Oh,
but
yes.
As soon as
the government intervenes, we're fucked. And that's the biggest issue for me, that the government is more and more willing to integrate this in an attempt to put an absolute control in the market, which by itself we might cause a bigger crisis or create an even more declining rate of growth, which we already live in a period of non-economic growth in the West, which is stupidly
not the West.
Well, Europe, but which is the majority of the West, which ironically many people are happy about, somehow believing that lowering economic growth is going to decrease environmental damage. Anyway, thank you, Lucas, for this. Please, guys, if you have more specific questions you want to ask us about, especially Lucas, please say so in the comments below. Like and subscribe, and stay tuned for more. Goodbye.